I have spent my life studying the echoes of history, tracing the footsteps of those whose ideas outlasted their era. And few have left a mark as profound as Benjamin Graham. To some, he was simply a Wall Street analyst, a teacher at Columbia University, a man writing books in quiet offices. But to those who understand the language of risk, patience, and prudence, he was much more. A guardian of reason in a world often seduced by greed. Today, I want to take you on a journey through one of Graham's most powerful ideas, a principle so simple yet so transformative that it has saved countless fortunes and preserved sanity in the chaos of markets. It is called the margin of safety. Imagine, for a moment, a bridge spanning a turbulent river. You know the engineers estimate it will hold a certain weight. But what if you built it twice as strong? What if, no matter how fierce the storm, no matter how many unexpected loads it bears, it remains standing? This is the essence of the margin of safety. It is the shield that protects the investor from error, misfortune, or misjudgment. It is the quiet discipline that separates the speculator from the true investor. In the next 20 minutes, we will walk through Graham's world, the roaring markets of the 1920s, the heartbreak of the 1929 crash, and the lessons he codified in his timeless books. We will see how these ideas were forged in the fires of crisis and how they can still guide us in today's complex, unpredictable financial world. But understanding this principle is more than just memorizing a definition. It is about seeing the market with a historian's eye, recognizing the patterns of human behavior, and learning to protect what truly matters: your capital, your security, your peace of mind. And yet, what happened next would challenge everything even Graham believed about investing. Benjamin Graham was born in 1894 in London, England. His early life was marked by both promise and hardship. When he was still a young boy, his father, a successful businessman, passed away, leaving the family in uncertain circumstances. This loss brought both financial strain and a life lesson in the fragility of fortune, a lesson that would quietly shape his cautious and analytical approach to investing. Soon after, his family moved to New York City, where Graham grew up surrounded by the energy and ambition of a bustling metropolis. Even as a child, he showed a remarkable curiosity for numbers, business, and the flow of money. He devoured books on finance, history, and human behavior, quietly preparing himself for a life in the world of markets and investments. By the time he entered Columbia University, Graham was already cultivating the analytical mind that would define his career. There, under the guidance of professors who valued rationality, discipline, and logical reasoning, he began to refine the questions that would later become central to his philosophy. What is this asset really worth? What are the risks? How can I protect myself against uncertainty? These questions, simple yet profound, planted the seeds of what he would later call the margin of safety, a principle born both from intellect and experience, honed in a young man who had already seen how fragile financial security could be. Even with this keen mind, Graham's most important lessons were still ahead, lessons that would be tested on the turbulent streets of Wall Street in the years to come. By the time Benjamin Graham stepped onto Wall Street in the 1910s, he had already developed a disciplined mind, one that questioned assumptions and demanded evidence. The financial world, however, was anything but disciplined. It was a place of speculation, of rumors, of fortunes made and lost almost overnight.
Graham quickly learned the difference between investment and speculation. To him, investment was a careful, reasoned process, an analysis of intrinsic value, of risk, and of the margin by which one could protect against error. Speculation, by contrast, was gambling, driven by hope, emotion, and the dangerous allure of instant profit. The 1920s were a decade of excess. Stocks soared, and the excitement was contagious. Even the cautious observer could be swept up in the optimism. Yet Graham remained vigilant. He observed companies carefully, studied balance sheets, and sought to understand their true worth. His approach was methodical, almost clinical. He was not interested in chasing market fads or participating in the frenzy of speculation. It was in these years, amid the rising tide of market euphoria, that Graham began to formalize the ideas that would later define his career. He started to see patterns, how human psychology could drive markets far from reality, and how a disciplined, value-focused approach could protect the thoughtful investor. And then came the test, the stock market crash of 1929. It would challenge every assumption, every calculation, and ultimately every investor. But Graham's careful philosophy, built on reason, analysis, and caution, would allow him to survive and teach the world a lesson that still echoes today. The year was 1929, and the stock market had become a spectacle unlike anything the world had seen. Prices soared to dizzying heights, fueled by optimism, speculation, and a belief that the good times would never end. The streets of Wall Street were alive with energy, with men and women chasing fortunes as if the rules of reason no longer applied. Graham watched closely, unshaken. He had seen bubbles before in smaller forms, and he understood that the market is never entirely rational. But nothing could prepare even him for the sheer scale of the collapse that was about to come. When the crash hit in October, billions vanished almost overnight. Investors panicked, fortunes were lost, and despair gripped the nation. Yet amid the chaos, Graham's philosophy shone. He had always insisted on analyzing the intrinsic value of a business, the actual underlying worth of a company's assets and earnings. He had built his decisions around a buffer, a protective layer he called the margin of safety. For Graham, this wasn't just a technical term. It was a principle of survival. It meant buying an investment for less than its intrinsic value, creating a cushion against error, volatility, and the unpredictable twists of fortune. During the Depression, many companies went bankrupt, but those that had solid fundamentals survived. Graham's investors, guided by his principles, were able to weather the storm. They had a safety net that speculation alone could never provide. And yet, even with this protective margin, Graham realized something profound. The margin of safety was as much about mindset as mathematics. It required discipline, patience, and the courage to stand apart from the crowd, a lesson that every modern investor would do well to remember. But what exactly is this margin of safety? And how can it be applied beyond the turmoil of the 1920s? That is the question we must explore next. The margin of safety. It sounds almost simple, almost obvious, yet its power lies precisely in its simplicity. At its core, it is the principle of buying an investment for less than its intrinsic value, creating a cushion against error, volatility, and the unpredictable twists of fortune. Imagine you're crossing a bridge. You know engineers estimate it can hold 10 tons, but you only place 5 tons on it. If the estimate is wrong, if the river beneath swells, if unseen weaknesses appear, your load is safe. That is the essence of Graham's philosophy. The margin of safety is the financial bridge that protects your wealth. But this is not just a number on a spreadsheet. It is a mindset. It is a recognition that the future is uncertain, that markets can be irrational, and that human judgment is fallible. Even the smartest investor can make mistakes, and even the most careful analysis can encounter unforeseen events. The margin of safety is the shield against these risks. During Graham's lifetime, he applied this principle in countless ways. He studied companies, dissected balance sheets, and looked for situations where the price was far below what the business was truly worth. A stock that traded at $50 but was intrinsically worth $75 offered a safety margin, a buffer against market swings and misjudgments. And today, in modern markets, the concept remains just as vital. While the instruments may have changed, stocks, ETFs, or even cryptocurrencies, the underlying principle is timeless. Always know what something is worth, and never pay full price if you hope to survive the storms that inevitably come. Yet, as Graham discovered, applying a margin of safety is not a mechanical process. It requires judgment, patience, and a careful balance between caution and opportunity. It is here, in this delicate tension, that the true artistry of investing emerges. Benjamin Graham believed that not all investors are the same. Some are cautious, some ambitious, some willing to devote endless hours to research, others content to let their money work quietly. To address these differences, he divided investors into two broad categories: defensive investor and enterprising investor. The defensive investor seeks safety above all else. They want to preserve capital, avoid mistakes, and maintain peace of mind. For them, the margin of safety is wide and forgiving. They focus on solid, established companies, diversified portfolios, and investments that require minimal ongoing attention. Their goal is not to become rich overnight, but to protect what they have while earning reasonable returns. The enterprising investor, on the other hand, is willing to study, analyze, and take calculated risks. They search for undervalued opportunities that others overlook, often going deep into financial statements and market trends. For them, the margin of safety is still essential, but it can be narrower because they actively manage the risk, applying skill and judgment to identify bargains that the cautious investor might miss. Consider an example from Graham's era. A defensive investor might buy shares in a blue-chip company with stable earnings, knowing that even in a market crash, the investment is unlikely to collapse. The enterprising investor, however, might spot a struggling firm whose assets are undervalued and whose potential is overlooked by the market. With careful analysis and patience, this risk can turn into a significant opportunity, but only if the margin of safety is respected. Even today, these categories remain relevant. In modern markets, some investors prefer low-risk index funds or dividend-paying stocks, while others dig into overlooked sectors, small-cap companies, or even distressed assets. In both cases, Graham's principle applies. Without a sufficient safety margin, wealth can evaporate as quickly as it is gained. And yet, Graham had a warning. No strategy, no matter how carefully executed, is foolproof. That is where his most surprising insights come into play.
Even for a disciplined mind like Benjamin Graham's, the world of investing holds surprises, and not all lessons are intuitive. Some of his most profound insights go against the instincts that drive most investors. For instance, Graham warned that cheap stocks are not always safe, and expensive stocks are not always doomed. A company might look undervalued on the surface, but hidden problems, poor management, unsustainable debt, or declining demand can erode its value. Conversely, a company trading at a high price may be justified by strong fundamentals, future growth, or a durable competitive advantage. The margin of safety, he reminded, is not a formula, it's a judgment, a careful weighing of risk and reward. Another counterintuitive idea: sometimes doing nothing is the best action. In a market dominated by speculation, Graham often preferred patience over action. He would wait for opportunities that clearly offered a margin of safety rather than chasing fleeting trends or hot stocks. In the 1920s, while others rushed into the market frenzy, he remained cautious, and his patience was rewarded when the crash of 1929 arrived. Graham also understood that emotions are the enemy of sound investing. Fear and greed drive most market movements, yet a rational investor, guided by principles, can exploit these swings rather than be consumed by them. Buying when others are fearful, selling when others are greedy, these are simple words, but in practice, they require discipline, courage, and a steady mind. Even today, these lessons remain strikingly relevant. Modern investors, faced with news cycles, social media hype, and fast-moving markets, often forget that the greatest gains and the greatest protection come from rational patience, careful analysis, and a respect for the margin of safety. And yet, despite all his careful planning, Graham's own philosophy evolved through moments of challenge, reflection, and discovery. This brings us to some of the turning points in his thinking. Benjamin Graham's philosophy was not static. It evolved through experiences, crises, and careful reflection shaped by events that tested both his intellect and his principles. There are three turning points that reveal how his thinking matured and how the margin of safety became central to his teaching. The first came with the 1929 crash. Witnessing the devastation of the market firsthand was a sobering lesson. Graham realized that even careful analysis could not eliminate risk entirely. What mattered was the buffer, the safety net that allowed investors to survive when the world around them fell into chaos. It was here that the margin of safety transformed from a concept into a lifeline. The second turning point was the publication of Security Analysis in 1934, co-authored with David Dodd. This work formalized Graham's insights, providing a framework for evaluating securities with discipline and rigor. Investors could now apply his methods systematically, scrutinize assets, assess earnings, and calculate intrinsic value. The margin of safety became a principle embedded in every analysis, ensuring that careful investors could act with confidence, even in uncertain times. The third turning point arrived with The Intelligent Investor, published in 1949. Here, Graham simplified and refined his ideas for a broader audience. He recognized that not all investors had the time or skill to analyze financial statements in depth. He distinguished between defensive and enterprising investors, emphasizing that the margin of safety was universal, its application adjusted to the level of engagement, skill, and risk tolerance of each individual. These moments show that Graham's lessons were forged in reality, tested under pressure, and refined through experience. They also demonstrate a profound truth. Investing is not a formula or a shortcut. It is a practice of thought, patience, and prudence. And as Graham's philosophy matured, he uncovered insights that often surprised even the most disciplined followers of his methods. The wisdom of Benjamin Graham may have been forged in the markets of the early 20th century, but its lessons remain strikingly relevant today. The margin of safety is not a relic, it is a guiding principle for anyone seeking to preserve capital and invest wisely, no matter the era.
In practice, it begins with understanding intrinsic value. Before buying a stock, an investor must ask, what is this company truly worth, based on its assets, earnings, and potential for growth? Once you know that, you can seek to purchase at a price significantly below that value, a buffer that protects you from unforeseen risks, market swings, or even errors in judgment. Consider a modern example. A blue-chip company temporarily undervalued due to market panic or short-term setbacks. A patient investor, applying Graham's principles, can recognize that the stock is trading below its true worth and use the margin of safety to invest with confidence. Conversely, an overpriced stock, even from a strong company, can be dangerous if the price exceeds its intrinsic value. Graham's principle also teaches discipline in the face of market noise. Today's investors are bombarded with news, hype, and social media trends. Prices fluctuate wildly, and sentiment can swing from euphoria to fear within hours. The margin of safety is the anchor in this storm. It reminds investors to focus on fundamentals, not hype, on value, not speculation. Finally, the principle applies across asset classes, not just stocks. Real estate, bonds, and even newer instruments like ETFs or commodities can be approached with the same mindset. Know the intrinsic value, maintain a buffer, and avoid overpaying. In essence, Graham's margin of safety is about more than protection, it is about empowerment. It allows investors to act decisively, think rationally, and sleep peacefully even when markets are turbulent. And with this timeless principle in mind, we arrive at the final lessons of Graham's enduring wisdom. As we come to the close of this journey through Benjamin Graham's life and philosophy, it becomes clear that the margin of safety is more than an investment strategy. It is a philosophy of prudence, discipline, and resilience. Graham taught us that wealth is preserved not by chasing the latest trend or succumbing to market hysteria, but by understanding the true value of what we own and leaving room for error. The margin of safety is that space, that cushion that allows rationality to triumph over emotion and reason to prevail over speculation. His lessons are timeless. Know what you own. Don't rely on popularity or hype. Understand the fundamentals. Buy below intrinsic value. Always leave room for error, whether due to miscalculation or unforeseen events. Be patient and disciplined. Avoid impulsive decisions and let opportunities come to you rather than chasing every market movement. Respect human psychology. Fear and greed can distort perception, but reason and analysis can guide action. Adapt to your own style. Defensive or enterprising, the margin of safety applies to every investor, tailored to skill and temperament. Today, whether markets surge or stumble, Graham's wisdom remains a beacon. By applying these principles, we not only protect our money, but also cultivate a mindset that can endure uncertainty, navigate volatility, and grow steadily over time. In the end, the margin of safety is not a formula or a rule. It is a way of seeing the market, a way of thinking about risk, and a shield that preserves both wealth and peace of mind. For anyone seeking stability in an unpredictable world, Graham's insight is simple, profound, and eternal. Invest with care, protect what matters, and always leave room for safety. And with that, we carry forward the legacy of the father of value investing. His lessons not just preserved in books, but alive in every thoughtful decision we make in the markets today.